Let's look at problem 5. Again, we're solving for adjusting journal entries. We're given these beginning balances at the top, or unadjusted balances, I should say, and then we're asked to solve for various things. So in the first one, we're really just asked to solve for depreciation, and a lot of this is just being able to do the math. The equipment, we can see cost up here. It cost $192,000. So, $192,000. At the end of its 16-year life, the company anticipates they can salvage it or sell it for $24,000. So that means they anticipate consuming $168,000 of the cost of the equipment. So that's the amount we want to depreciate over the 16 years. So we know that we're going to consume 168, and then let's spread that over the 16 years. So that's roughly $10,500 annually. So we just saw for our annual depreciation expense to be $10,500. And so I'm going to squeeze in real quick. That would be a journal entry, debit depreciation expense, $10,500. And then our related account is the contra asset accumulated depreciation. I'm just abbreviating it to make it simple. So accumulated depreciation, which is a contra asset, $10,500. Number 2, the note payable is a 90-day note given to the bank on October 20th and bearing interest at 8%. And to keep things simple, they only want us to use 360 days instead of 365. Okay, so here's our note payable, $90,000. So using principal times rate times time, we know our principal is $90,000. We have an interest rate of 8%. And then we need to figure out time. We need to figure out how many days out of 360 in order to get our interest expense. So let's kind of figure it out. If it started on October 20th, let's see, the remaining days in October, there are 31 days in October, so 31 minus 20, there would be 11 days. So that note would have been outstanding for 11 days in October. And then in November, there are 30 days in November. And then in December, there are 31 days. So add those up and we get a total of 72 days. Okay, so let's go back up here to our formula, plug in our 72 days out of 360. So $90,000 at 8% over 72 out of 360 would be our interest cost of $1,440. Okay, so here would be our journal entry. We would debit interest expense, just going to abbreviate interest as an I, and we would credit, we haven't paid it yet, so it's an interest payable. So I'm abbreviating payable, P-A-Y. All right, let's go on to the next one. Number 3, in December, there were 2,000 coupon admission books were sold at $30 each. They could be used for admission anytime after January. Okay, so let's go back and look at how did they record that. So the coupons, we normally would have thought that when they sell a coupon, we haven't delivered anything yet, so that would be unearned revenue. But we don't see any of that here, right? Don't see any unearned revenue. So then I have to wonder, well, how did this get recorded? And this is a really good example of what a professional accountant does. Somebody else, really, an accounting clerk, probably made that journal entry. So he or she just kind of guessed what they thought the account would be. So we have to reason through. We're reviewing their work, and we're going to correct somebody else's work, which an auditor or an accounting supervisor would do in the real world. So we're going to pretend we're an auditor or we're the supervisor reviewing somebody else's work, and we're going to correct it. Well, if they didn't put it into unearned revenue, what's the other logical place? Likely they put it into the revenue account itself. So likely that got put into the revenue account. But it's actually unearned revenue, isn't it? So we know we need to credit. I'm going to go ahead and do my credit first. We need to credit unearned revenue I think it's actually going to be unearned service revenue, but I'm just going to write it down as unearned revenue because we know $60,000 belongs there. Now, for the debit, figuring that out, well, it went in revenue, so we need to take it out of the revenue account. So I'm going to debit admissions revenue to reduce it and take it out of there. Okay? All right, so again, on all of these adjusting entries, you really do have to look at what has been recorded. Where did it originally go? Because somebody else is usually making that original entry. It's more of, the administrator or the manager or supervisor that comes in and does these adjusting entries. Okay, and the last one, advertising expense paid in advance, including an advertising expense. So let's go take a peek and see, is that what actually happened? Yeah, we can see there is an advertising expense, but if it had been paid in advance, I actually would have expected to see an asset account for prepaid rent, or excuse me, prepaid advertising. So we can see there's an error here. They've put some monies into advertising expense that actually should have gone into prepaid. So this $1,100 we need to debit to increase prepaid advertising. So debit the asset account. So debit the asset account, $1,100, and we're going to take it out of the advertising expense account to make that correction. So we want to take costs out of the expense and put it into the asset. Again, we're increasing an asset there. Oh, I thought that was the last one, but there is one more. Salaries and wages accrued, but were unpaid, $4,700, so there wouldn't have been a prior entry for this. So we have wages and salary expense that hasn't been recorded yet. It hasn't been recorded yet because it hasn't been paid. If it hasn't been paid, it's a payable. So wages and salary payable. So put it in a liability account. Okay, then the last one, we're actually to solve for what would be the balances in these accounts. So I've really sort of set it up. We need to see, well, what were the balances before? So if I go back and look, I'm just going to take, like interest expense 1,400 and put that in down here. So interest expense started out at $1,400. Admissions revenue, if I go back and look, that was $380,000. Put a little comma there. Advertising expense started at $13,680. And salaries and wages expense started at $57,600. Okay, so let's go back and we'll just look at our adjusting entries. Forgot already. Let's see, we're looking for interest expense. So where did we make a journal entry for interest expense? Number 2, we debited to increase interest expense. So we had adjusting entry number 2, debited interest expense to increase it, $1,440. And that gave us an ending balance of $2,840 for interest expense. And you can finish these out, but I'll do it real quick. Let's see, so for revenue, didn't have any there. But here we reduced admissions revenue $60,000 by a debit. So we had an adjusting entry to reduce this $60,000. And that ended up with $320,000 then as our adjusted balance. Advertising expense. Number 4, we reduced advertising expense $1,100 because we credited it. So reduced it $1,100. So $13,680 minus $1,100 is $12,580. And then salary and wages expense, we increased it $4,700 with that debit in number 5. So plus $4,700. gives us an adjusted balance of 62,300. 62,300. Okay, and there we are, finished with problem 5.